Good morning, everyone, and welcome to the first of two financial internal controls workshops. And today's workshop is entitled Overview of Financial Risks and Controls and Effective Financial Governance. My name is Sabrina Dimitra, and I'm AMSA's Settlement and Integration Program Manager, and I'll be facilitating today's workshop. I'd also like to, before we begin, acknowledge that as a provincial umbrella association, AMSA acknowledges that BC is on the unceded homelands of the First Nations who have stewarded this land since time immemorial. We recognize the privilege that we have as settlers on this land and acknowledge that AMSA's operations is on the unceded traditional territories of the Musqueam, Squamish, and Tsleil-Waututh First Nations. I'd also like to recognize that I'm joining you today from the unceded traditional territories of the Katzie, Kwantlen, and Stolo First Nations. And our presenter for today is Gordon Holley, who is the co-founder, president, and CEO of Humanity Financial Management. Humanity Financial Management works exclusively with social purpose organizations to help them build internal financial capacity. And so I'll let Gordon introduce himself further and hand over the webinar now to him. I'm looking forward to hearing your content, Gordon.
Wonderful. Thanks so much, Sabrina. Good morning or good afternoon, everybody, depending on where you are in the country. So today we're going to be talking about, we've broken the session down into two sections, and we'll be taking a small break between the two sections. The first section is going to be on financial internal controls, protecting your assets and reputations. And then the second session will be on financial governance. As Sabrina mentioned, my wife and I run a CPA firm in Vancouver, BC. I think we've got about 25 people or so now. I'm a co-founder and president and CEO of the organization. I've been a CPA for about 30 years, and I've got about 45 years of board experience, cumulative board experience. Started when I was about quite early in my career, and mostly as treasurer. So I've had a significant amount of experience as treasurer on small local organizations, mid-sized organizations, and large national organizations. At Humanity Financial, we help organizations build financial systems, skills, and capacity within the social purpose sector and Indigenous organizations. So we work exclusively with social purpose organizations. And we're different than most other firms because we don't do audits, we don't do reviews, we don't do tax returns. We work specifically on building and supplementing internal financial capacity in organizations. And we work with charities, nonprofits across the country, a number of First Nations and Indigenous organizations. We love the work that we do. We've got a very dedicated, passionate team that are, we call ourselves humanitarians and activist accountants, really working to support our clients and making the world a better place. So we're thrilled to have the opportunity today. I'm thrilled to have the opportunity today to be presenting to you. We are a certified B Corporation, and in fact, we're the largest certified B Corporation accounting firm in Canada. There's only two of us. We are the largest. We're hoping more will follow. In case you haven't heard of B Corporations is a certification process you go through if you want to use business as a force for good. And so this is we commit to being a multiple bottom line organization. We provide careers and learning and growth opportunities to our team members. We provide great value to our clients. We have a light touch on the environment. We work on our supply chain to make sure that we're using good suppliers, and we give back to our community. And all of those are measured as part of the B Corporation certification process. So we use the profit that we earn to again contribute to making the world a better place. And this is just a small subsection of the clients we're currently working with. I got to tell you, we absolutely love working in the social purpose sector. Clients are very, first of all, they're our heroes. They work often crazy long hours, and they have incredible missions. Again, all working really hard to make the world a better place, and we're really happy to be able to support them in doing that. So this week we've got two 2-hour webinars. The first one today, as we mentioned, is going to be an overview of financial risk and controls, and then we'll talk about effective financial governance. And on Thursday, we're going to talk about compliance with funding contracts and compliance with regulators. So different focus for each of the 2 days. Today's a pretty sort of high level focus on governance and risks and internal controls at a high level, and then we'll be getting down into some fairly good detail specifically with funder contracts and regulators on Thursday. So the first question that people ask is, okay, I'm working with this organization because I'm really passionate about the cause, and why do I need to care about financial governance and financial management? Well, first of all, registered charities and not-for-profit organizations are often tasked with stewarding the funds provided by others in order to achieve their mission. And so they take on a responsibility, the organizations take on a responsibility as fiduciaries, trustees, guardians of that money, and commit to spending it well toward the mission. We're going to talk briefly about the primary financial governance risks that we see in the sector, what's at stake. We often get the question, is my organization at risk? And I'll tell you that yes, every single organization is at risk, and we'll talk more about how many organizations are subject to or succumb to financial risks shortly, and we'll show you some actual news stories. So financial governance and internal controls are not the most exciting section for people that are passionate about achieving their missions, but they are absolutely critical because it's virtually impossible to achieve your mission if you've had financial challenges. So really important, really critical to the sustainability of all organizations. So I really appreciate the fact that you're all coming out today to learn more about this. So I mentioned that all organizations or social purpose organizations typically make a commitment to their funders to take responsibility for the funding, to ensure that they're using it toward achieving their mission, and they're essentially managing money on behalf of someone else. And there's really a higher bar here. It's one thing if you're managing your own money, it's another thing if you're managing on behalf of other people. And so there really is a responsibility for the organization as a whole, and that's everybody in the organization, not just the board members and the CEO, but all the staff members, all the support team, everybody that works in the organization takes on a responsibility to participate in this, their financial roles and responsibilities, and the overall stewardship of the organization's funds. Now, these are what we think that the primary financial risks are to most social purpose organizations. First of all, you'll see here, well, first of all, because we're not for-profit organizations, or the people on this call are not for-profit organizations, you don't have, income taxes isn't generally a risk, but occupational and employee theft, fraud, and embezzlement are a significant risk, and we'll get into some statistics in that in just a minute. Running out of cash is a significant risk. Many organizations don't take the time to prepare cash flow projections and end up either with a source of cash that doesn't come in or just overspending their budgets and running out of cash. CRA payroll, and I'm going to add GST reassessments in here, but these are one of the biggest risks we see because many leaders of nonprofit organizations aren't aware of the difference between independent contractors and employees. And as a result, if you hire people as independent contractors and pay them as independent contractors, and you don't make appropriate income tax, CPP and EI remittances, you can be held liable for those, and the CRA can go back multiple years if they consider that you've been negligent. And that can put organizations out of business because the interest and the penalties, in addition to the amounts withheld when many charities and nonprofits, a significant portion of their expenses, often 60 to 80% of their expenses are payroll. This can literally put an organization out of business. And then the final one is losing your charitable or NPO status. If you lose your charitable status, this can result in it's a 100% revocation tax, where basically the CRA says, if we have to revoke your charitable status for any reason, you need to either contribute all of your assets, including cash, investments, buildings, anything that you own, to another charity, or you can pay it to the CRA. And there's actually a form they have that you fill out to essentially, it's a tax form that tells you how much you have to remit to the CRA. And then there's also reputational risks, inappropriate asset use, ineffective asset use, and reporting errors. All of those can reduce the level of trust and confidence that people have in your organization. So also important to watch out for. This is a wonderful quote, and I'm just going to read it out from a book called Governance is Leadership on the importance of reputation. And basically, it says, armed with a strong reputation, a nonprofit will be favorably positioned to access capital markets, recruit talented staff, attract capable trustees, and engender public support. Reputation may not be everything, but whatever occupies second place ranks far behind. So that just gives you a sense of how important reputation is. So what's at stake for our organization? Well, as we just mentioned, reputation is key, but it can also result in, if an organization has a financial challenge or succumbs to any of those risks, they can have difficulty attracting future funders and donors. They can have difficulty attracting board members and staff, can make it difficult for them to achieve their mission and potentially go bankrupt. On the personal side, and this is a personal risk for directors, they actually take on, usually when you incorporate, so if you're an incorporated society or not-for-profit corporation, that typically protects directors from financial liability unless they're negligent. But there's a few things it doesn't protect them from. And that are, those are payroll. If the organization's unable to make payroll, they can come after, the employees can come after the directors personally. If the organization's unable to make its payroll or GST remittances, the CRA can come after the directors personally. So there's some personal financial liability there, and also potentially lawsuits and loss of reputation. So it's important for the organization. Financial governance and financial management are important both for the organization and for the board of directors. We had this question come up at a recent, what was it, a seminar, I guess. And there was a partner from Ernst & Young, and it was his view that every single organization, whether it's a for-profit or nonprofit, has some level of occupational theft, fraud, or embezzlement going on. Most of it's very small. You know, it can be things like taking home, staff members taking home office supplies for personal use, but can also go up to multi-million dollars fraud. And so putting in appropriate internal controls can reduce that risk significantly. This is a report, PwC does an annual or biannual economic report on economic crime. They're saying that, and this was the 2018 report, that economic crime is on the rise. Their economic crime and fraud survey finds that 55% of Canadian respondents say they've experienced economic crime in the last 2 years. And think about this, 55% over 2 years, that's almost a quarter of organizations every year. And they go on to say, but what about the other 45%? Have they avoided falling victim or simply don't know about it? And this is the critical piece for us. We think most organizations are suffering some form of economic crime on an ongoing basis, but many of them just don't know about it yet. And in fact, one of the statistics is that it often takes 18 to 24 months for organizations to uncover occupational theft, fraud, or embezzlement. There's an organization, a global organization based in the US called the Association of Fraud Examiners. And in their 2020 report to nations, they report that fraud in nonprofit organizations have a median loss of $95,000 and an average loss of $639,000. So this can be significant if you've got a smaller organization and you're hit with a significant instance of occupational fraud. It can make a significant difference to your financial sustainability. They also note that the frauds are larger, the more senior the people committing the frauds, and they give a listing here of all of the different types of fraud and their regular occurrence. They also indicate that nonprofits are significantly more vulnerable and susceptible to occupational theft, fraud, or embezzlement because they have fewer anti-fraud controls in place. And you can see by the chart here that in virtually every instance of internal controls, the nonprofits have about 20% fewer nonprofits have appropriate controls in place. So it's absolutely critically important that organizations pay attention to this. Now, how do we detect occupational theft, fraud, or embezzlement? Interestingly, about 37%, between 37 and 40% are actually tips from staff, from suppliers, from the people we serve. The next 3 items, if we add up internal audits, management review, and account reconciliation, that also comes to about 37%. So between those 4, which is tips and in management internal controls, we're capturing about 75% of all the fraud that's detected. And then there's about 25.6% that are other, including external audits. And you'll see that external audits are only at about 3.7%, which is extremely low. Many people think because we're audited, that's going to detect occupational theft, fraud, or embezzlement. And unfortunately, it only uncovers about a little over 3.5% of those. So it's not really a high-level effective internal control, or it doesn't protect nearly as much as people think it does. And in the charity sector, there's been some estimates, well, actually, this is an estimate for the for-profit sector. 5.7% of all gross annual revenue is subject to theft, fraud, or embezzlement. That number is taken from the for-profit sector. We think the number is probably double this, but even if we say it's the same as the for-profit sector, in Canada, our charity sector in 2018 was about $284 billion of revenue. So the annual loss is somewhere between $12 and $18 billion a year. That money could much better be spent serving the people that the charities and nonprofits are serving across the country. So this is a serious problem, and it's one that many organizations don't focus enough on preventing. With appropriate internal controls, you can absolutely prevent most occupational theft, fraud, or embezzlement, and many of the other financial risks. And interestingly, when you look at who's committing occupational theft, fraud, or embezzlement, it's often the people that we trust most. It's often the CEOs or CFOs, the people in senior management positions who have worked for the company for more than 10 years and who are between the ages of 30 and 50. And these are often the people that we trust most. They've been around the organization forever. They know how the organization works. They are in positions of trust, and we have no reason to doubt their honesty. So it just goes to show you can't rely on individual people and personalities. You really need to have systems in place and appropriate systems to make sure that everybody's playing by the rules and not taking advantage of the organization. Cybercrime, also another significant risk. For the first time, I think it exceeded asset misappropriation and consumer fraud. Many organizations don't have appropriate controls in place over the potential for cybercrime, can result in the loss of employee or donor data, and can actually represent a significant financial loss if people take inappropriate actions to emails that are coming in, or there's some kind of identity theft. Ideally, there should be prominent, the cyber controls should be prominent in risk management plans, and you may want to check with your auditor or insurance provider about what you can do to improve your cybersecurity and reduce the risk of being hit with cybersecurity. We 2 years ago started taking out cybersecurity insurance for our firm, and the plans are improving and becoming much more reasonably priced. So we highly encourage organizations to look into getting cybersecurity insurance and talking to a tech firm about what they can do to improve their ability to withstand cybersecurity attacks. Okay, before we go on, I'd like to open it up for questions so far.
Yes, thank you so much, Gordon. And so please let us know if you have any questions. You can do so by raising your hand, and we'll ask you to unmute. Or you can also send your questions in the chat box. Alternatively, you can also send your questions via email to AMSA as well. We have received a few questions that were private messaged to me. And one of them is, what is the difference between external and internal auditors?
Oh, great question. So your external auditors are the external accounting firm that comes in typically once a year to perform an audit of your external use financial statements. And so these are external people, and they're preparing the audit report, which typically is available to external third parties. An internal audit is your internal staff members who conduct some review or oversight of your financial processes. And so often, particularly in larger firms, as firms get larger, as organizations get larger, they tend to have more internal audits. Where they task their internal staff members with certain tasks that provide review and oversight to financial processes, and determine whether or not staff members and employees and board members are all following the organization's financial policies and procedures appropriately. So going back to the chart from the Association of Fraud Examiners, I think we mentioned that internal audit is a significant component of the internal controls. We don't typically see a lot of internal audit in smaller organizations. They just don't have the capacity. But as organizations grow, it's important to consider whether it would make sense as part of an internal control process to actually start performing internal audits to make sure that your organization's following its financial policies and its its documented financial processes and procedures.
Thank you so much, Gordon, for explaining. And there was a follow-up by that individual. Is there a pro or a con of either of them that they should be aware of?
Oh, well, generally speaking, your funders are going to require an external audit. So that's usually not an option for most organizations. Unless you're very small. And so, a good idea to have an audit, and for most people, it's going to be a requirement. The internal audit, also really important, and most organizations should try and have at least some internal audit processes in place, again, to protect themselves against all of the financial risks, but in particular, the occupational theft, fraud, or embezzlement. So both good, no cons that I can think of.
Perfect, Gordon. Thank you so much for clarifying. The next question is around cybersecurity. How much considerations should cyber risk play into organizations' financial risk management? And has this risk increased now with many services being offered online with hybrid service delivery, working from home, etc.?
I think cyber security risk has increased exponentially over the past few years. This is not an area that I'm expert in, but I think if you talk to, because we've been talking to our technology service providers, we've recently significantly increased. In fact, I think, tripled our investment in our technology area to protect ourselves and our clients from cybersecurity risk. It's lately has been hitting all kinds of organizations, from hospitals, municipalities, universities, and believe it or not, all kinds of charities and nonprofits. They really seem to be indiscriminately attacking anybody that they can get through to. So, yeah, cybersecurity risks are increasing exponentially, and it's up to every single organization to make sure that they're protected. Some of the things they're doing are holding your data for ransom. So, for example, they lock down your server and say, your server is now encrypted. We're not going to give you access to your server again unless you pay us $20,000 or $100,000. And that's happening fairly frequently now. The loss of donor and staff personal data is happening. There's all kinds of very significant risks that just didn't exist on any kind of scale 10 or 15 years ago. It's now becoming prevalent, and I'd encourage every organization to at least turn their mind to whether they're adequately protected.
Thank you so much, Gordon. And with that being said, the follow-up question is also around, what role should funders or could funders play in supporting organizations in to be able to increase their cybersecurity?
Oh, great question. We are firm believers in best practices for funding. And generally speaking, best practices for funding are providing significantly less restrictions around funding, knowing that the organizations themselves, the people that are on the ground dealing with the clients, dealing with the people we serve, actually understand what their needs are generally better than funders do. So ideally, funders are providing more operating grants, more capacity building grants, and more money specifically that the organization has control over, that isn't subject to, spending limits, or they should not be having significant restrictions over what you can spend on overhead and administration. Funders are the larger funders certainly are moving in that direction. The 5 largest foundations in the U.S. are now significantly moving in that direction. More and more organizations, as a result of the pandemic, have been loosening restrictions on spending. So that's certainly a direction we hope to see more and more funders following, and certainly worth having that discussion with your funders, because the funders want organizations to be financially sustainable, but if they don't provide the funding for organizations to protect themselves, they're opening the organizations they fund up to significant risks. And that's a great conversation to be having with your funders, to help educate them about what the risks are, and hopefully enlist their support in protecting your organization against those risks.
Yeah, thank you, Gordon, for highlighting, that there's a role for organizations and for funders, working together on this topic. So I'm just checking in to see if there's any more questions, and I'm seeing none. So maybe we can move on with the content, and then we'll see if there's going to be some more questions later on. And if you had a question but didn't think of it for this section, please feel free to add it for later. We do have some more Q&A periods throughout this workshop this morning.
Sounds great. Thanks, Sabrina. So I want to just take a couple of minutes to talk about the articles that are showing up in the newspapers around the world. Here's a cover of the New York Times sports section a few years ago, back in 2016, on the trusted grown-ups who steal millions from youth sports. Prosecutors in several states say embezzlement investigations involving youth sports have become common. This just, I was aghast. I couldn't believe that this was a thing. These are youth soccer organizations, youth football organizations, youth hockey associations, and people taking on responsibility for managing that money are embezzling it and stealing it. And this is happening all across our sector. Here's another article, I think, from the Boston Globe on employee theft shockingly common at nonprofits. And I think the final slide I have on this is here. Here are just a number of examples that showed up on NBC News. Just some examples. The bookkeeper of the Ann Arbor Amateur Hockey Association has pleaded guilty to taking more than $934,000 from an account the association had established to build its own hockey rink. And there are multiple examples here of the Fairmont Marion County Food Pantry discovered $54,000 was missing. That Tamaqua Elementary School had to cancel its field trips for the year after discovering $34,000 had vanished. The Marine Corps League in Sevier County lost nearly $60,000. Like these are just, I subscribe to Google Alerts for charity and nonprofit theft, fraud, embezzlement, and I get emails in my inbox every single day about nonprofits and charities that are losing money to occupational theft, fraud, or embezzlement. So this is, and we think that many of the people committing these acts aren't getting caught. So it's not even showing up in the news for many organizations. So then it raises the question, what can we do to protect ourselves? Well, maybe surprisingly, a lot more than most people think. We don't have to be passively accepting risks. There's a lot that organizations can do with a little bit of investment, mostly of time and energy in protecting themselves against financial risks. So certainly we recommend that all organizations go through a formal or informal, but a more formal risk identification and management process to identify the significant risks faced by the organization, and then hopefully put in place some internal controls to protect against those risks. And we also think it's really important to have the right people on your team with the right skills, particularly in the finance department, that you have robust budgeting and financial reporting systems, and there are adequately documented financial policies and procedures. These are sort of the four big things that we think organizations can do to get the most bang for their buck in terms of investing time and energy in protecting their organizations. And we'll go over each of these in detail. So identifying and managing specific risks. And big picture, we can take a potentially high risk process, and we can significantly lower that risk by implementing effective internal controls. And this is true. We see it in all the reports from the Association of Fraud Examiners that the organizations that had strong internal controls seldom experienced significant occupational theft, fraud, or embezzlement, and those organizations with fewer controls were at far higher risk and experienced significantly more problems. So the process we talk about is a relatively straightforward one, and it generally takes organizations maybe an investment of anywhere from 6 to 10 hours of staff and board time, maybe a little more, to go through a risk identification and management program, or to start a risk identification and management program. And it usually starts with a 1 or 2 hour session to identify the primary risks that your organization faces, and noting what the potential consequences could be. And then the second step is we evaluate those risks according to both the likelihood of occurrence and the potential consequences if the risk occurred. And that gives us a sense of how we can prioritize our internal controls, because it helps us identify what the primary risks are, what the highest risk items are, and which ones we should be focusing our time and energy on. You can certainly spend a lot of time putting in financial policies and internal controls for a lot of low risk areas. We're of the view that if you actually go through a conscious and intentional process of identifying the risks for your specific organization, given its current board, given its current staff team, and given its current operating environment, and then focus your internal control efforts on the highest risks, you can cover off most of your high risk and convert it to low risk with appropriate internal controls. And then after we've assessed the risks, we develop controls to make the risk decisions. And then item number 4, we implement the internal controls. And item 5, we supervise and evaluate. And this just becomes an ongoing cycle where organizations are continually updating their risk assessments and continually updating their internal controls. And this is one of the primary tools that organizations use. It's one version of the tool called a risk register. And you can see from the various columns here, we start in column 1 just with the number of the risk. We just number all the risks so we can talk about them. The second column is the actual risk to the organization. In the third column, we've evaluated the likelihood of it happening on a scale from 1 to 5, with 5 being the highest risk and 1 being the lowest risk. And in column number 4, we've evaluated the potential impact should the risk occur, again on a scale of 1 to 5. And then we multiply those 2 columns to come up with the severity of the risk. And you'll see that these are evaluated. I think anything over 15 is a red. And then below that, we've got orange and yellow and green as the least risky. And you can also see that after these risks have been evaluated, we've then implemented some identified and implemented some mitigation strategies. And as a result of that, with those strategies in place, we've reevaluated the risks. So this is the residual risk that the organization has. And now there are no red risks and a significant number of more green risks. So we've significantly de-risked the organization and hopefully gotten the risk down to an acceptable level for the organization. But this is the kind of process, and it doesn't have to be a crazy long process. As I say, this is somewhere between maybe a 10 and 20 hour for smaller organizations. Larger organizations, it can take longer. But it's not a significant investment of time for the potential payback, or I should say the payback is very high with respect to reducing risk of going through this a more formal risk identification process. You'll see here we've just listed, these are internal categories of risk: governance, strategic, operational. Really up to the organization how it wants to group its risks. I've seen other organizations use pyramids. And there's also a number of external risks: environmental, economic, political. There's all kinds of different risk categories organizations can use to group and assess their risks. Again, I'd like to open it up quickly for questions. If anybody has any questions on risk identification and management processes.
Yeah, thank you, Gordon. And please let us know if you have any questions in the chat, or feel free to use the raise hand function by clicking on the reactions button and selecting raise your hand, and we'll call on you. We did receive some questions. The first one is, what strategies do you have for mitigating risk with theft while not creating an increased workload for staff who are already having to manage an increased workload?
Yeah, great question. And this is a real challenge for many organizations, because what we know in our sector, organizations are chronically underfunded. We know that. And they're underfunded generally with respect to the people they're trying to serve, and they're underfunded specifically for operational and capacity building and risk reduction and mitigation strategies. So it's a real challenge in the sector. I don't have any quick answers other than hopefully we're able to have transparent conversations with our funders. There used to be a page on the internet called the overhead myth, and it was put on by a number of organizations that were trying to dispel the myth that overhead is a bad thing, that people should be spending all their money on programs and none on overhead. Because, and this was put up by the three main charity rating agencies in the US, because they realized that if you focus and try and reduce everybody's administration, you also significantly increase the risk of the organization going out of business, of the organization providing worse service, or the organization succumbing to some kind of significant risk. And this is where we've got to figure out as a sector how to invest more in protecting our organizations and our board members and team members from these growing risks. So unfortunately, it's generally, I think, going to be solved by raising more money and getting funders to reduce restrictions on funding. And as much as that's very difficult to do for many organizations, it's important, but it's seldom urgent. So it's a challenge in the sector.
Yeah, thank you, Gordon, for highlighting that challenge. Another question that we received was around, do you have any examples of a robust budgeting and a reporting system?
Oh, great question. I mean, that's one of the services we offer to clients, is helping them design robust budgeting and reporting systems. I'm not sure. I don't think I'm aware of any sort of free resources that are available. There's certainly lots of articles and podcasts. I would encourage you to look into organizations like NPQ, Nonprofit Quarterly Magazine, or Blue Avocado, or Propel Nonprofits, or Board Sources, a bunch of sources of really good information around designing robust budgeting and reporting systems. You know, it also depends on which financial accounting software you're using. So yeah, I'm not sure I have any specific. We did include in the digital workbook for these sessions, there are some templates for financial policies and procedures and other things. We've got some things in there on internal controls and on financial roles and responsibilities, but I don't think there's anything specifically on budgeting and financial reporting. Honestly, I don't think I've seen anything that's available, at least on a free basis, that would be useful.
Yeah, thank you so much. And also thanks for mentioning the workbook. Gordon has created a workbook for the sector, and it's quite a robust resource. And we're going to be sharing and disseminating that in both English and French following these workshops with everyone. So you'll have all of that content to follow up on. I'm just checking to see if there's any further questions for Gordon. Seeing none at the moment, I think we can maybe continue with the content, and then we'll see if there's any further questions that'll come up.
Wonderful. Thanks, Sabrina. So the first thing, and this is, you know, I think all organizations recognize how critical this is, but having the right people with the right skills, and in particular, the right financial skills. Ultimately, the board is responsible, but this responsibility is often dedicated to the CEOs and executive directors of making sure that they have the right finance team in place. Often we find in small to medium-sized organizations that there are some roles and responsibilities that are missing, and those are typically around the controller and CFO positions. Those roles can be performed by other people, but often they aren't. Either, you know, usually small to mid-sized organizations often rely too much on their bookkeeper and open themselves up to significant risk. So having the right people with the right financial skills, making sure that you've got skilled people on the board that have some financial literacy and experience and skills, that ideally you've got a CPA in your treasurer position and heading up your audit and finance committee, that your executive director and CEO has some financial skills and background and experience. And then in an ideal world, you've got, maybe a part-time CFO or maybe a part-time controller assisting and reviewing the work of your bookkeeper, and also program directors and program staff. If they've got, often we get program managers involved in budgeting and reviewing the budget compared to actual results. So having the right people in place, ideally hiring people with making sure that everybody in the organization has the financial skills that they need to complete their roles, and also providing financial literacy training, and helping people program managers acquire budgeting skills, and to make sure that everybody has the skills and experience they need to adequately protect the organization. So again, I mentioned, ideally you're looking for the full team, everybody to have financial skills. There's an error in this slide here. I used it for another presentation that really should say migrant services societies. But the key is that the people you have both volunteering and working for your organization need to have financial skills. And often it isn't a competency that we select for. And I think more and more organizations now are starting to increase the financial involvement of everybody in the organization. And they're now starting to, certainly from a best practice perspective, starting to hire employees and volunteers at all levels of the organization that have appropriate financial skills. From a financial roles and responsibilities perspective, you'll always hear auditors talking about segregation of duties, but this is really trying to make sure that no one person should be able to perform all of the functions within an accounting cycle and have the ability to cover up an intentional or unintentional accounting error. And the more levels of review, the better. So if somebody's in charge of looking after a particular asset, like a bank account, you don't want them doing the record keeping. You want somebody else doing the record keeping. And you also want somebody else authorizing transactions. And then ideally you have another person that's doing the reconciliation. So in an ideal world, as I say, you got a bookkeeper, and then the controller reviews the work of the bookkeeper, and then the CFO reviews the work of the controller, and the treasurer reviews the work of the CFO. So, and we recognize that not all organizations can afford to have full-time positions for all those roles, but we certainly recommend that most organizations at least identify what the roles are that are usually performed by a controller and a CFO, and make sure that somebody's taking on those roles, whether it's the treasurer, although if you do that, you may burn through your treasurers fairly quickly. Maybe your executive director has some financial skills and experience and can take on the role of controller and or CFO. But somebody needs to be taking on all of the roles, and there needs to be appropriate review to have effective internal controls over your finances. And just from a definitional point of view, here's what we consider to be the critical financial roles. The bookkeeper is usually paying the bills, doing the data entry, doing some bank reconciliations and credit card reconciliations, performing the payroll and issuing T4s, making sure we've got WorkSafe BC insurance or Workers' Compensation Board insurance in other provinces, making sure that we're meeting our obligations for sales tax, and doing some basic reporting. The controller's primary role is really the accuracy and completeness of the financial reporting, whether internally to the board or the management team, or externally working with the auditor. They review the work of the bookkeeper and support the bookkeeper and make sure that the financial controls are operating effectively. They'll also track and report on financial key performance indicators, and typically also help put together budgets and provide actual to budget variance reports on a regular basis. The controller is also usually responsible for contract management and making sure that the organization is meeting the financial reporting requirements with respect to all and any of the funding contracts they have. The CFO is typically tasked with ensuring that the organization is financially healthy and that it's performing, that its financial performance is improving over time, and that the organization's financially sustainable. So they're often designing the financial key performance indicators. They're often managing the risk management, making sure there's a risk management process in place, looking at things like asset planning and preservation. If the organization needs to purchase significant assets like buildings or automobiles or anything else, so there's appropriate processes in place for that. They often manage the banking relationships and the relationships with external lawyers. Now, the treasurer's role is generally a volunteer role. They chair the finance committee typically, and their primary role in theory should be board facing. Ideally, they're not actually treated like one of the staff or taking on the CFO and controller responsibilities. Their role in a best practices environment would be to educate the board, to help interpret financial reports and make sure the board understands the ramifications of the financial reports. They're facilitating strategic thinking within the board and developing the financial literacy of the board and advising the management team on what additional reporting the board might need in order to meet its fiduciary obligations. If you're looking for a CPA as your treasurer, there's all kinds of places to go look. You can start at your auditing firm if you have an audit done or a review engagement. Ask your auditor if anybody at their firm would be interested in taking on the position of your treasurer. Charity Village has free postings for volunteer positions. Many of the provincial CPA job boards have free postings for volunteers. And there's also organizations like Vantage Point that has Go Volunteer, which is an online matching service for volunteers and organizations. Okay, does anybody have any questions with respect to hiring the right people for their organizations?
Yes, Gordon, thank you so much for coming and for sharing all of this content. We do have some questions, and I just wanted to also say, please feel free to raise your hand if you'd like to ask Gordon your question directly by clicking on the reactions and then raise hand function. Some of the questions that we have are around, if you can, what tech tools are there, or would you recommend for an organization to really help to support, to effectively manage some of these internal controls, especially if different staff are taking on different elements, and with the fact that many staff are currently working from home or in a hybrid work environment?
Yeah, interestingly, we haven't seen a lot of technology being used for these processes because they're mostly around policies, processes, and procedures, and making sure that there is appropriate review of all the financial transactions. And so it's not, I mean, certainly in some of the larger, like for large organizations, there are opportunities to build in internal controls into your financial accounting software because they become more like an enterprise resource planning system where everybody in the organization has access to the financial system. And so invoices are paid. I often have purchase order systems, and you often have authorizations for payment systems. Most of our clients use an electronic check writing service called TellPay, which has some internal controls built into it. You can have two people electronically sign checks from anywhere in the country. So there is some technology that's available to improve internal controls, but mostly I think for many organizations, it's more making sure that the organization goes through the risk identification and management process, identify what its key financial and non-financial risks are, implements internal controls, making sure that there's appropriate reviews and appropriate protections for the big risks that could ultimately hurt the organization. So yeah, there are certainly tools available. budget templates, cash flow templates, but in terms of technology for implementing internal controls for organizations using software like QuickBooks or Sage 50, I'm just not sure there's a lot built into the technology. You could certainly, yeah, I'm not sure how to answer that beyond that. I'm not seeing it doesn't seem to be a big category of offerings today.
Thank you, Gordon. And another question that's come through a private message to me is just around that an organization, that they have a CPA who they know, and that they've become hesitant in becoming a volunteer treasurer due to additional liabilities and possible legal implications due to their professional designation as CPA. Could you maybe speak to that? The question is like, is this accurate? Is this true? I'm just trying to get some more clarification around that.
Yeah, great question. And this really is a legal issue. But I'll tell you what I've seen so far. For the most part, most risk for professionals being on the boards isn't as high as they think, because my understanding, and this is just my understanding, this is not an area of expertise for me. I'm not a lawyer. But my understanding is that the minimum bar is what a reasonable person would do. My understanding is that the law does not impose a higher bar on professionals who volunteer on nonprofit and charity boards. And then the other piece to keep in mind is that one of the requirements I have for participating on a board is that the organization has appropriate directors and officers insurance coverage. And I think that's becoming pretty much the norm now. So between those two things, I don't think there's a huge amount of potential liability in most organizations for professionals to participate on the board, but you'll want to get specific legal advice around that. And also make sure that you've got appropriate directors and officers insurance in place.
Thank you so much, Gordon. Another question is, you mentioned around having different staff take on different aspects of the accounting cycle. And so one question that I received from somebody is, what if we don't have that many staff where we can split things up? So are there any suggestions of how, if you have a limited number of staff who you can split up? Some organizations say that they have 1 to 3 staff members, how they could maybe look to split things up accordingly.
Yeah, well, great question. And absolutely you can. It's certainly more difficult in smaller organizations to have appropriate segregation of duties, and I think everybody realizes that. But there are things you can do. You can have your different people authorize transactions. You can have board members authorizing some transactions. You can have administrative staff provide some review if they have some financial skills. But again, I think the big thing, even in smaller organizations, is to make sure that you do have the appropriate financial skills and experience for your organization, because your organization, regardless of its size, is not immune to financial risk. And often it means you've got to figure out, bringing in a part-time controller or a part-time CFO, you've got to figure out a way to make sure that you're adequately covered to prevent risk. And that's incumbent upon all organizations, regardless of size.
Thank you so much, Gordon, for speaking to that smaller center reality as well. I just wanted to see if there's any other questions. I don't see any coming through on the chat to me, but I just wanted to see if there's any others. Seeing none, I think we can move on to the next section, and then we'll see if any other questions come up in the meantime.
Sounds great. Thanks, Sabrina. So the question came up about robust budgeting and reporting systems, and in this case, you really need robust financial systems throughout your organization, even smaller organizations, financial transaction processing systems, financial budgeting and reporting systems, ideally creating budget variance reports by funder and contract and by program and project, and making sure that there's appropriate board reporting and financial literacy at the board so the board members can actually understand the reports. And I'm going to go through this fairly quickly because we've provided in the digital workbook some template policies. We generally have, this is what we consider to be sort of the minimum for the smallest organizations. Here's 10 basic financial policies. You know, no electronic access to bank accounts unless it's read-only. No spending without an approved budget, appropriate segregation of duties and appropriate review, cash management of petty cash procedures, spending authority, payments to directors, hiring staff and contractors, as we mentioned, because of the potential payroll risk, and regulatory compliance. You know, many smaller organizations try and adapt a set of financial policies from another organization. This can be appropriate if the organization is very, very, very similar. But in many instances, it doesn't work because the organizations are different and there's different risks for the organization. So if you're thinking about using a template, consider highly customizing it for the risks that your organization faces, or potentially working with a consultant. We included in the digital workbook are some checklists for financial management internal controls. And here's the table of contents, just so you can see we've identified a number of internal controls in each of these areas. We've also got in the digital workbook, we've also included a financial management roles and responsibilities guide, which goes over the financial management roles and responsibilities in each of these areas. These are the typical internal control techniques for finances, and you'll see that interestingly, not many of these are well fitted into the tech tools that were asked about earlier. They're things like supervision and review, management and board reporting, human resources, policies and procedures, analytical review, appropriate segregation of duty, audit trails, and reconciliations. For larger organizations, there's the Committee of Sponsoring Organizations have come up with an enterprise risk management framework. This is completely impractical for most smaller organizations, but for larger enterprise level organizations, it's worth learning about the COSO best practices. Again, with respect to, this is just a summary of why should we care about these. I hope I've made a pretty good case for why everybody should care about these financial internal controls. It's really protecting the assets and reputations of both the organization and the directors, and making sure that the organization is going to be financially sustainable over time. But ultimately, having a good reputation for financial management and financial governance allows us to attract and retain better funders, board members, staff, reduce the risk of loss, and meet expectations of external monitoring agents. And also, if we could figure out how to have that extra $12 to $18 billion to service our clients, all the better. And as I mentioned, what we can do to protect ourselves, this is implementing strategies to mitigate risks and internal controls, identifying and managing specific financial risks, getting the right people with the right skills, creating robust budgeting and reporting systems, and creating basic financial policies and documented financial policies and procedures. Here's a couple of quick resources on managing financial risk. So 20 questions nonprofit board and directors should ask about overseeing management of risk. And there's also CPA Canada offers a nonprofit governance summary resource guide. There's some great resources there, in particular one called A Guide to Nonprofit Financial Statements to help board members understand them better. Here's some resources on risk management. We mentioned COSO for smaller organizations. We've got our checklist. There's also a nonprofit policy sampler at BoardSource, and First Reference is a pay-for service where you can download templates for all kinds of different internal controls. Here's just an outline of what's in the digital workbook. There's a number of our specific tools, some job descriptions for bookkeepers and accountants, as well as some links to resources from the Bridgestone Group, BoardSource, Blue Avocado, and Wegner CPAs. So now we're going to be switching gears a bit and talking about sort of a higher level financial governance and what processes and procedures can organizations take to improve their financial governance. I mentioned that, we had a slide in the previous section that outlined the primary financial governance risks. Here they are again, just as a reminder. I just want to talk briefly about terminology because it's often a bit confusing. When we talk about the legal status of an organization, they're generally unincorporated or they're corporations. And in the nonprofit world, these are typically societies under most of the provincial acts, although in Ontario and the federal Canada Nonprofit Corporation, they actually set up corporations as opposed to societies. They can also be trusts and cooperatives. So that's the sort of social purpose world from a legal status point of view. When we talk about accounting and tax status, the Canada Revenue says you can either be a not-for-profit organization or a registered charity, but not both. When you're first registered, your legal status will be either a not-for-profit corporation or a society, but not-for-profit organizations can also apply to become registered charities. So the terminology can get a bit confusing. When we talk about financial auditing, accounting and auditing standards, both nonprofits and charities are included under the title of nonprofit organizations and the accounting standards for nonprofit organizations. So from an external audit perspective, nonprofits and charities are treated all by the same rules, but at the Canada Revenue Agency, they have different rules depending on whether you are a nonprofit organization or you have gone through the process of becoming a registered charity. And we'll talk more about that in our session on Thursday when we talk about the regulations that apply to nonprofits and charities organizations. We'll note that charity regulation in particular, charities are regulated technically under the legislation that you incorporate under and by the Canada Revenue Agency. And often these rules are conflicting. So the CRA doesn't always get it right. And I also want to mention that incorporation legislation varies significantly by jurisdiction. And the types of things that can vary a lot are like whether or not you're required to have a review engagement or an audit with respect to your externally used financial statements, whether you can operate a business, whether you can earn a profit, and whether you can make payments to directors. And the point here is that it's really important to understand, to have somebody in the organization, hopefully more than one person, that actually has read through both the CRA regulations and the Societies Act, and is aware of your constitution and bylaws. It's really important that somebody has gone through the process of making sure that your organization is staying on side of the regulatory environment that your organization is subject to. There are different roles specifically for members and directors, and the big thing to recognize is that most organizations have both members and directors, and they're often different groups. Members don't have any legal responsibility. They can have impact on the organization through votes and other things, but nobody's ever going to sue the members. Directors, on the other hand, do have, and this goes back to the question that was asked earlier, directors do have some responsibilities and they can be sued. So it's important that directors take their roles seriously and that they, in most of the boards that I'm on, they include copies of things like the Constitution and bylaws. They include things like the Societies Act that the organization's incorporated under. And they include things like, the CPA Canada Guide to Understanding Nonprofit Financial Statements. So there's some really good work and resources available for directors to make sure that they're discharging their appropriate responsibilities. But it takes some work on behalf of the directors to figure out what those are. These are the typical responsibilities that we've identified legally in Canada: to have a duty of care, make sure the organization has the resources it requires and be prepared for and attend meetings; a duty of loyalty, to put the organization's interest above your own, and this is identifying things like conflict of interest; And then statutory duties, ensuring compliance with the regulatory environment, constitution and bylaws, and board governance policies. These are all roles for individual board members. The board does have financial governance roles and can delegate some of these roles to the leadership team or the management team, but they often retain primary and ultimate responsibilities to make sure that all of these things are getting done. You can't just abdicate your responsibility. If you're going to delegate it, you need to review it and make sure it's being done. So you want to make sure that the organization has the appropriate financial resources to achieve its mission, that financial risks are identified and managed, that money is spent effectively to maximize mission achievement and impact, that there's robust financial budgeting and reporting systems, that the organization has people with appropriate financial skills, and that the board has appropriate financial skills, that the board's receiving appropriate financial information from the management team, that there are documented financial roles and responsibilities, policies, procedures, and processes, and the organization's in compliance with its regulatory environment. And these are areas where the board often requires significant support from its management team and leadership team. So that group can do a lot to make sure that the board is meeting their financial responsibilities. But I want to make the point here that there are financial responsibilities throughout the organization. It's not, financial responsibility isn't just relegated to the bookkeeper or the finance department. Everybody has a hand, and the more people that have financial governance and management skills, the better for the organization. Again, I would encourage all organizations, as part of their hiring processes for all positions, to have some questions about people's financial skills and abilities, and be selecting people because they have appropriate financial knowledge. You know, like program managers should be able to prepare a budget and review budget to actual variance reports and explain significant variances and manage their programs and their budgets accordingly. And that's true of all of these positions. There are roles and responsibilities, financial roles and responsibilities for everybody in the organization. Here are the roles and responsibilities generally allocated to audit and finance committees. To the extent you have two separate committees, if you're a larger organization, if you're a smaller organization, you probably combine these two. It talks about the membership. You want at least one CPA or financial expert. Committee procedures, you generally want to review its charter and come up with an annual work plan. The audit committee typically focuses on audits, both external and internal, on regulatory compliance and risk management and internal controls. And their focus is on external reports and audited financial statements. For the finance committee, they typically focus on financial budgeting and financial reporting, on asset management, internal reporting to the board and to the management team, statements of financial position, budget comparisons and cash flows, and typically monitoring a third-party investment advisor if you have investments. But in many smaller organizations, as I say, these two committees are combined. There's a wonderful book, and it hasn't been updated in a number of years, but I don't think it's changed. I don't think it's changed significantly. And this is called A Primer for Directors of Nonprofit Corporations. And it's available electronically on the internet. You can provide a link to your board members. I highly recommend including this in your board orientation package. It's not long. It's a few-hour read, but it really gives directors an overview of what their rights and duties and responsibilities are. So highly recommended reading for all board orientation packages. This is an overview of the governance framework for nonprofits and charities. There is legislation and common law, which governs the roles of society members. The society members typically create the constitution and bylaws for the organization, and they elect a board of directors who's then subject to that constitution and bylaws. The board of directors creates governance policies and procedures and hires the management team who creates operating policies and procedures. The society members also appoint the auditor, The board of directors typically appoints a finance and audit committee, and management typically hires employees and volunteers. So this gives you an overview of what the governance framework is in nonprofits and charities. But I also want to say that funders often take it on a disproportionate role, and there's a real risk of mission drift if organizations go after funding, even if it doesn't specifically suit their mission. So it's just important to be aware that it's, think about the funding you're going after and make sure that it's helping you achieve your mission. With respect to building capacity in your nonprofit organizations, there's a wonderful book, and it's actually becoming a movement now throughout North America, and it's called the Nonprofit Life Cycles Institute. And they make the assertion that the mission and programs of the organization are supported by our administrative systems, our business model or our funding source, our governance structures, and our management structures. And if any of these table legs are weak or not sufficiently strong to support the programs and the mission, our programs won't be as effective as they could be, and we may not achieve our mission. So it's really important to have a strong foundation in all of these areas, and this is becoming gradually more important to funders over time, and more funders are providing support for all of these things, recognizing the importance of these four table legs in supporting programs and mission. So, and in fact, all of the research that's been done around funding for nonprofits has come to the conclusion that investments in capacity building and sustainability are basically the foundation for nonprofit success. So the more you can learn about these types of things like the overhead myth, the Nonprofit Life Cycles Institute, puts you in a better position to be able to negotiate funding for these infrastructure and supporting systems to support your programs and the achievement of your mission. They suggest that, and this was a book by Susan Kenny-Stevens, and in her book, she suggests that all organizations are at different points in their life cycle capacity development. And organizations typically go through a process where they can go, from an idea stage to a startup, into a growth phase. They reach maturity. There's a potential for them to go through a decline and a turnaround and potentially go out of business. And so they ask organizations as a framework to self-assess or work with a facilitator to assess where they're at with respect to their programs, their management, their governance, their financial resources, and their administrative systems to identify opportunities for improvement. In an ideal world, the organization should be highly aligned. So whatever stage you're in as an organization, ideally your programs, your management, your governance structure, your financial resources, and your administrative systems are all in the same category. If any of those things is in a significantly different category, usually lower, because organizations mostly excel at delivering programs, and often their supporting infrastructure is less well developed, then it provides opportunities for improvement that can support organizational sustainability. And we think there's really three keys to effective financial governance, and that is looking after long-term financial sustainability, managing annual financial performance, and having processes for financial risk management in order to protect the assets and reputations of the organization. And we're going to go through slides on each of these three items. So you'll see on the left-hand side what we usually refer to as the three pillars to effective governance, and this is visioning and planning, monitoring and control, and policymaking. And we've put these side by side with the three pillars of effective financial governance, which are long-term financial sustainability, annual performance monitoring and control, and financial risk management and asset protection. With respect to long-term financial sustainability, here are some of the tools that organizations can use to improve their long-term financial stability. One, making sure that they have an enduring vision mission, values, and a definition of the impact that they want to have as an organization. Having a long-term strategic plan or a long-term strategic framework that provides a North Star for the organization. Having evaluation and impact measurement systems. This is something that funders struggle with because they want to be allocating their dollars to organizations that are going to have the most impact per dollar. And if organizations struggle to measure and define their impact, it's harder to convince funders that their dollars are best allocated to the organization. So having an impact evaluation and impact measurement systems in place go a long way toward being able to convince and demonstrate to funders that you're actually having the impact that you hope to have. Making sure you've got the right funding model and diversity of revenue streams. Interestingly, we see some organizations that actually have too much diversity in the revenue streams, and they're not able to build the capacity internally to be effective at raising all of those revenue streams. So sometimes it's possible to have too much diversity of revenue. Using benchmarking as a tool, the CRA, for example, if you're a registered charity, the CRA will provide you with comparative information, the T3010 data, for any charity in Canada. So you can benchmark yourselves compared to other similar types of organizations across the country. And then making sure that you've got appropriate strategic operating reserves and lines of credit can provide a fallback in case you ever have cash flow issues. Many organizations that had strategic operating reserves were well positioned when COVID hit because they were able to use their operating reserves to pivot and to move to digital service delivery or other things. Similar organizations that didn't have strategic operating reserves in place or lines of credit, many went out of business over the course of COVID because they just didn't have the resources required to make the significant pivots required. So that's all long-term financial sustainability and things that organizations can do to ensure their long-term financial sustainability. Now we're going to talk about annual performance monitoring and control. Now, most nonprofit organizations and charities have annual operating plans and budgets, or at least annual budgets. We like to see the integration of an annual operating plan with the budget, which is specific goals and objectives, because really, I can't evaluate a budget unless I know what we're trying to achieve and what goals we're trying to achieve over the course of the year. So having an operating plan with SMART goals and appropriate project management and implementation integrated with the budget is the best tools you can have for both goal achievement and for managing annual financial performance. Having some performance planning and improvement processes, having regular board updates and reporting, so the board's actively involved in ensuring that the organization is managing its finances appropriately and taking corrective action as required. And then finally, financial risk management, implementing policies, procedures, processes, make sure everybody's really clear on their roles and responsibilities. You want to make sure we've got that financial risk identification and management that we talked about earlier, making sure we've got the right people with the right financial skills, that people have the right financial roles and responsibilities. And you can see in the digital workbook that we outline most of the high-level financial roles and responsibilities, and that all organizations require. And so it's important to go through and make sure somebody is taking on each of those financial roles and responsibilities, even if you don't have a controller or a CFO. Making sure you've got the right financial systems for budgeting, accounting, and reporting, that you've got the right financial governance policies and documented governance policies, that you've got the right financial processes and procedures, again, documented processes and procedures to make sure that they're consistent and everybody can follow them, that your organization at all levels of the organization has appropriate financial skills, training and education for their roles and responsibilities, that you're compliant, that you have systems to make sure you're compliant with regulations and with funders, And just one of the other tools is a board mandate, a board work plan, and a board calendar to help the board manage their work over the course of the year. With respect to documenting financial roles and responsibilities, we've provided detailed position descriptions in the digital workbook for the treasurer. But ideally, all the financial roles and responsibilities are documented and allocated to specific individuals. We need to ensure that all people have the appropriate financial skills for their role in the organization. We may want to conduct background checks to make sure that people haven't been involved in other frauds. We saw the other day that a bookkeeper that was convicted of fraud was hired by another organization. And I think that happens a fair bit because organizations don't do background checks. You'll often want a matrix or a checklist to make sure that those financial roles and responsibilities are being delivered on. Build in segregation of duties and adequate review processes where you can. Provide training and access to technical support around finances, and have some kind of internal audit function, even for smaller organizations, to periodically ensure that everyone's doing their jobs and that adequate reviews are being done. Here's just an example of the accounting procedures manual that's in your digital workbook, a link to this, which is with Blue Avocado. It's quite a well-organized one for a smaller organization, and could provide a good template to start to develop your own if you don't already have one. Going back to the question earlier about, tech tools for financial internal controls, I don't think there's a lot of those, but there are non-tech related things that we can do to improve financial governance. And these really are typically process and procedure based, policy based. So it's documenting financial roles and responsibilities, documenting financial policies, documenting processes and procedures. And we recognize that this isn't the reason that most people get involved with a nonprofit organization. Most people get involved because they're passionate about the cause and they're passionate about the mission of the organization. But unfortunately, many people need to be turning their mind to financial governance in order to ensure the financial sustainability of the organization. I mentioned a resource earlier that I wanted to just highlight called the Guide to Financial Statements of Nonprofit Organizations, Questions for Directors to Ask. This guide is actually really useful, not only for directors, but also for people on the management team. Anybody that's going to be looking at and trying to read and understand a set of audited financial statements for nonprofit organizations. And these include registered charities. This is a great guide and often takes reading through a few times to really understand, because even though they've tried to keep it in lay terms, there's still a lot of jargon and some of the concepts are quite complex. But definitely worth reading if you want to understand nonprofit financial statements. There are a significant number of sources of information on internal controls. The Association of Certified Fraud Examiners in the US, well, they're global, but they're based in the US, does an annual report to nations, and we had some examples in our slides earlier. There's a wealth of information up on their website. All of it's free. And there's great information up there on internal controls or lack thereof, what organizations struggle with and what they can do to improve their internal controls. CPA Canada has a webinar on internal controls and fraud prevention for small and medium-sized nonprofit organizations. It's relatively well priced at $275. COSO for larger organizations, the Committee of Sponsoring Organizations of the Treadway Commission, has come up with the standards for enterprise resource risk management for larger organizations. And the IRCC, Immigration and Refugee Canada, I think, has provided, all of your organizations with internal controls and fraud prevention cover letter and a recipient guide on best practices for internal controls and fraud prevention. And they provided the funding for these presentations this week. So there's lots of information out there. And there's organizations like ours that can also assist with any of these things, implementing and improving organization systems of internal controls. So which will give us time for some questions. There's some links to resources here. I think these are all included in the digital workbook. So there's a couple of templates for accounting policies and procedures manuals, and also a nonprofit job description toolkit. And the nonprofit job description toolkit at Bridgespan has job descriptions for controllers and CFOs at different sizes of organization. And we've also provided I think, Word documents for job descriptions for senior bookkeepers and treasurers. So take a look at those templates if you have the opportunity. And with that, Sabrina, I'd like to open it up for questions. I think we've got about 10 minutes before we wrap up.
Perfect. Thank you, Gordon, for going through the rest of the content. We've received this question a few times in the chat, but I just wanted to share how everyone can access the digital workbook. And so this is something that AMSA will be sending you via email later today. We will be sending it to you both in English and in French. So then you'll have access to both versions of that digital workbook. So some of the questions that we've received so far is, you mentioned that too much diversity of revenue earlier. Could you explain a little bit how much does this, how would this affect an organization? It wasn't 100% clear what you were referring to earlier.
Oh yeah, no, I love this question. So generally speaking, most consultants will recommend that organizations have a diversity of revenue streams, which protects against the loss of any particular revenue stream. So you want to have more than one. You don't want to be entirely reliant on one revenue stream or one donor. Because if something happened in that relationship with the donor, your organization could be out of business. So ideally, you want to have, the best recommendations that I've seen suggest that 90% of your revenue comes from less than 3 revenue sources or 3 lines of revenue. And the reason for that is because it's in order to be effective at raising money, you need to build capacity in your organization for each of the different revenue streams. And if you try and become too many things to too many people, you actually have difficulty raising funds because you don't have the internal capacity. So you want to strike a balance between having multiple revenue streams in order to protect against losing any one of them, but you also want to build your capacity in a few revenue streams to make sure that you can raise funds efficiently and effectively.
Okay, thank you so much for clarifying. I hope that helps answer the question. The other question that I received is, what top financial control strategies can help organizations attract staff, particularly staff who have, financial capacity knowledge?
Well, great question. I mean, I think there are many organizations today, both in the for-profit world and not-for-profit world, struggling to attract workers and staff members. I think, and this really comes back to the piece we were talking about around financial sustainability and the things you can do, getting really clear about your organizational vision, mission, values, and impact. I think goes a long way toward attracting people to work with your organization. More and more people, particularly the younger generations now, are wanting to have a sense of purpose in their work beyond just earning a paycheck. And they're aligning themselves and searching out organizations that have a strong social purpose. So, and you want to be able to differentiate yourself from other social purpose organizations that are similar to yours, but being really clear about the impact you want to have as an organization and how you're helping to make the world a better place, I think is probably one of the biggest singular things we can do to attracting the right people. but also making sure that you have appropriate fundraising capacity so that you can pay your people well, pay them living wages, make sure they're paid market wages, and have appropriate benefits. The nonprofit sector has struggled forever on being able to pay competitive salaries, often because of not having the fundraising capacity to be able to raise enough funds to pay the staff what they would get paid in working for a for-profit organization. I think this is going to become critically important. COVID has shown how deep the challenge is here, and many people are starting to rethink where they want to work, and as I say, are aligning themselves with organizations that have similar values and purpose. So it seems to me like that's probably the biggest things we can do, is having being clear about the impact we want to have in our value proposition to the people we serve, and having enough fundraising so that we can pay our people competitive salaries and wages, and then having career growth opportunities. So there's some ideas.
Absolutely, Gordon. So thank you for sharing all of those. One final question before we look to wrap up today is, what tips would you have for an organization who's just starting to develop an effective financial strategies? Do you have any, kind of nuggets or suggestions to share?
Oh, interesting. Well, I mean, sure. There's a couple of places you can go. If you have an annual audit or review engagement, typically your accountant prepares a management letter, certainly for audits. And one of the least expensive ways to get advice and consulting on your financial systems is to ask your auditor to spend some time on their management letter and make sure that they spend a little more time on your system, evaluating your systems of internal controls and highlighting anything that they see that would be welcome improvements to your financial systems. Because often the auditor is already familiar with your financial systems, and it doesn't take a significant amount of additional work in order to provide you with that feedback. And also having audit planning sessions with your auditor before the audit starts, and having an audit evaluation meeting after the audit's finished can provide great sources of information with respect to your financial processes and systems. Having said that, many auditors don't take the time to invest a lot in that, and so typically don't provide that much useful information, and you may need to hire somebody else to do that. But there are a significant amount of really great sources for financial. There's a good series of articles by Propel Nonprofit Management on having a robust budgeting and reporting system. There's a website called strongnonprofits.org in the US that has a bunch of tools. We provided in the digital workbook a bunch of tools. So I think just taking advantage of some of the tools, doing more reading and understanding what the financial issues are for your organization, and making sure that you've got appropriate financial governance and management systems in place will go a long way.
Thank you so much, Gordon. Those were some really great suggestions, or some really great insights. So in closing, I just wanted to thank everyone for joining us for today's workshop. This is the part one of a two-part workshop series. And so we hope that you'll be joining us again on Thursday, October 7th. At the same time from 10 a.m. to noon Pacific for part two of the workshop. And so just want to say thank you so much, Gordon, for sharing. You've shared a great amount of information that I believe will be very, very useful for the sector. And I also just want to thank the interpreters for their time and effort in translating the content of today. And as well, I just want to thank the AMSA team who behind the scenes has been supporting today's workshop. And so we just wanted to, before we go, to invite you to stay connected with the settlement and integration sector by signing up for our weekly newsletter, Settlement Net. The link, we'll be sharing that in the chat, but you can also find that on the screen. And we will be letting you know via SettlementNet once the recording for this workshop is available and posted on the AMSA website. As well, we always welcome you to stay connected with AMSA via social media. And AMSA can be found on Twitter at the handle at AMSABC, as well as on Facebook and LinkedIn at AMSA-BC. And so thank you everyone for joining. We will be also sharing an evaluation with you. And so we'll be sending that out after this workshop. And so we just ask that you take a few moments to complete it, as we really rely on your feedback and input on further trainings and further suggestions. And so thank you everyone. Hope you have a great day. And looking forward to seeing you all on Thursday for part 2. Bye-bye.